Hey, welcome. Today, we're doing something a little different. We're going to put on our detective hats and dig into the insurance giant MetLife. Our mission? To follow the clues hidden inside its financial data and see what story they really tell. So let's get right into it. Our investigation starts with this number. And yeah, that's over $50 billion. That's MetLife's market capitalization. Right off the bat, a number that big tells you one thing. We're dealing with a massive global player. So what does that number actually mean, in simple terms? Well, it's basically the price tag the stock market has put on the entire company. You take all their shares, you multiply by the current price, and boom, you get $50 billion. But as any good investigator knows, the price tag is never the whole story. And that leads us to the big question, the mystery we're here to solve. Is MetLife stock some kind of hidden gem, just waiting to be discovered? Or is there a catch, a hidden risk that explains that price? It's time to follow the clues and find out. Okay, our first clue is all about that price tag. We need to figure out if the stock is a bargain or if it's actually overpriced. And to do that, we've got to look deeper than just the surface price. We need to estimate what the company might really be worth. You know, financial investigators have their own special set of tools for this kind of work. And one of the most important ones is a method that tries to calculate a stock's true value, its intrinsic worth, completely separate from all the day-to-day noise of the market. And that tool is called discounted cash flow, or DCF. It sounds complicated, but the idea is pretty simple. It basically looks at a company like a giant money-making machine. It tries to predict all the cash that machine is going to pump out in the future, and then it calculates what all that future cash is worth in today's dollars. So when analysts run the numbers on MetLife through a common DCF model, this is what they get, $482.24. Now, that is a potential fair value price for a single share based on those future cash flow projections. Whoa. Okay, let's just pause and put that into perspective for a second. The stock is actually trading for around $77, but this model suggests its fair value could be over $482. I mean, that is a jaw-dropping difference. Now, this huge gap between the current price and the estimated fair value gives investors something they absolutely love, a margin of safety. And for MetLife, that margin is a whopping 83.89%. To put it another way, it's kind of like buying something you think is worth $100 for only 16. That is a very, very compelling first clue. All right, time for clue number 2. For this one, we have to pop the hood and take a look at the company's engine room. Is it firing on all cylinders, or is it maybe sputtering a bit? In other words, is the company actually growing? And you know, at first glance, the signs look pretty good. When we look at the top line, that's the total amount of money coming in the door from sales, what we call revenue, the trend is definitely pointing up. Yep, check this out. MetLife's revenue has been growing steadily. Over the last 3 years, it's gone up at an average rate of almost 3.8% every year. So this tells us the company is selling more of its products. The engine seems to be running just fine, right? Well, this is where our investigation takes a sharp turn. Because just because more money is coming in the door, it doesn't automatically mean the company is actually making more money. And with MetLife, the data reveals a major plot twist. And look at this, in a complete flip from the revenue numbers, the net income, that's the actual profit left after all the bills are paid, has been falling. On average, it's dropped by over 14% a year for the last 3 years. This is a huge contradiction. So why is this such a big deal? Well, because it raises some really serious questions. It suggests that even though the company is getting bigger in sales, it's getting less efficient or less profitable at its core. It's a critical clue that really complicates the picture. Okay, for our third and final clue, we're going to look at how MetLife rewards the people who own a piece of it, the shareholders. And the best way to do that is to investigate its dividend, which is the slice of the profits it pays out directly to investors. And a dividend story here is really quite strong. First, the yield is almost 3%. That's a solid return. Second, its payout is healthy. It pays out less than half of what it earns. Third, and this is so important for sustainability, it only uses about 9% of its free cash flow to pay for that dividend. And finally, look at that history. 13 years in a row of giving its shareholders a raise. This clue points towards a stable, shareholder-friendly company. All right, our investigation is done. We've gathered all the evidence. Now it's time to lay all the clues out on the table, put it all together, and try to reach a verdict. So our investigators' notes show 2 totally different stories. The case for the stock, The bull case is built on that incredible potential upside from the fair value and that super reliable dividend. But the cautionary tale, the bear case, is all about that worrying drop in profits, which just raises a big question mark over the whole thing. When you put it all side by side like this, it really is a tale of two stories, isn't it? On one side, you've got these clues pointing to deep value and great shareholder rewards. And on the other, you've got this massive red flag about profitability. And this is often how it goes with financial deep dives. The clues don't always point to one simple answer. What we have here is a clear conflict between the different pieces of evidence, and it paints a really complex, nuanced picture. So we have to end our investigation here with a final question for you. The clues about value, they suggest a huge opportunity. The clues about growth, they're conflicted, to say the least. And the clues about income, they tell a story of stability. The data has spoken, but it's telling very different stories. So the question is, which one will you listen to?